Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. And today I'm joined with a good friend of mine, Shauna Wekherlien. How you doing, Shauna?
I'm doing fabulous. Thank you so much for asking.
Good. Well, I'm glad to finally get Shauna on the show. She's one of my favorite tax advisors. She is a wealth of knowledge. Wanted to get her on the show here as tax season is approaching. We want to give you the best knowledge you can, since there's actually a lot of other stuff. But Shauna, tell us a little bit about your background.
Absolutely. So, not sure how far back you want me to go. I started in
Relevant background.
relevant back. I was going to say I'm like astrophysics when I was 5. Where are we starting? Relevant background. So, I am a CPA, master's in taxation, certified tax coach, certified tax strategist. Which basically means that out of the 660,000 CPAs in the US, I am ranked in the top 3 specifically for tax strategy. So I always call myself a red-headed, fire-breathing, gold-grabbing dragon because I feel like I sit on little coins of knowledge and I get to help people with them. So all the good bits.
This is great. And yeah, that's you've come up with a lot of really cool stuff over the years. So really appreciate that knowledge. So tell us, right now, we've just gotten through the new year, and people are looking at their tax situation. They're wondering, how can I not pay a lot of tax this year? Obviously, it's a little too late for 2023, but still, there's a lot of good knowledge that people can take away from this and utilize for the upcoming year. So what should people be thinking about? What are some strategies, some high-level strategies people should be thinking about right now, Shauna?
Absolutely. Well, and I almost kind of feel like I need to break it into 2 sections. So if it's all right with you. So the first section is things, the end of the year is past, December 31st, done, gone. Okay. However, there are 2 main things that you can look backwards at. So one of them is the master's exemption, and the other one is an accountable plan. So without going into too much detail, right, but a master's exemption would allow you to go backwards, see if you had any staff meetings at your house, any business meetings at your house. Your business can pay rent to you via your accountable plan, as long as you get that done before January 31st. So if you're listening to this podcast on time, if you are here on time, before January 31st, work with your CPA to get an accountable plan set up. And that will allow you to go backwards, take the master's exemptions, and get, for most people, it's about $24,000 to about $50,000 of extra write-offs for last year. So last minute tip before January 31st. But
it's funny. I've never even heard of this, the master's exemption, the accountable plan. I wonder why.
That's a great question. Now, the master's exemption has multiple names. So sometimes it's called the master's exemption. Sometimes it's called the Augusta rule. Can you tell how the rule was created?
Yep, I know
the
that one.
Masters in Augusta, exactly. So the very long story short, big picture here, okay? 14 events per year. Your business can rent your personal home from you if you held business events at home. Now, you do have to come up with the fair market value of rent, right? So in some places, that's $500 per event. The highest I've ever seen was $17,800 in Manhattan, so per event, right? So these rates can really swing. But if you hold those business events and you pay yourself the rent, which is why the accountable plan, so I'll explain that here in a minute, why the accountable plan is so important. If you pay yourself the rent, that means that your business gets a tax deduction. You pick up the income, but when you pick up the income, it's 100% tax-free. So you get the cash and you get the tax deduction. It's like double dipping on the money. It's awesome.
That sounds pretty awesome to me.
Everybody's very happy about that one. So, and then the accountable plan, because in order to do that, those 2 things have to go together, right? You either had to pay the rent during the year when you held these events, or you have to run it on the accountable plan. So an accountable plan tracks anything that you personally spent on behalf of the business. So in this case, you personally laid out for this rental space, right? But for many people, they also are missing the accountable plan for things like home office, cell phone, personal vehicle used for business. In order to write all those things off properly, you have to have an accountable plan, an actual written document, and it's got to be reimbursed typically quarterly. So if we're at this point in the year, you may have missed the first 3 quarters, but you have until January 31st to reimburse for the 4th quarter of last year. So
nice. That's a great tip. I know I've definitely heard of the Augusta rule.
Yes, everyone loves that Augusta rule. It's such an amazing, the one thing I love about being a US citizen, right, is if the government write laws for themselves, it applies to us, right? So love it that the senators and congressmen pass the law for them, and yet we get to use it. So all the good things.
Sometimes they didn't allow us to use the insider trading rule that they get to benefit from. So it's not all the rules.
Very true. Very true. Very true.
I have more choice words than that for them, but that's a different story. Trying to keep this a family show. So what else? What other things can people be thinking about? I mean, those are great tips. But what else should people be thinking about this time of year?
Let's look forward, right? Because there's only, as you said, there's only so much we can do going backwards. So part 2 here, let's look forward. One of the biggest things as a tax strategist, right? So yes, I'm a CPA. Yes, I prepare tax returns, but I specialize in tax strategy. And normally what happens is about October, November, people realize, ooh, I made profit this year, and I made a lot of profit this year, and I'm going to have a really big tax bill, right? And so they come to a strategist looking to do strategy, right, before December 31st. And as a strategist, I'll come back to them and say, great, we're going to need $100,000, $200,000, $300,000, right? I have no cash. I spent all the cash, right? My CPA told me to buy 2 new trucks and to fund my 401k plan. I've got no cash, right? So one of my favorite things to talk to people about doing here in January is to start with something called Profit First. And the methodology of Profit First is to say, okay, instead of having my money come in, paying all of my expenses, and whatever's left is my profit, we're going to move that profit line first. So the dollars come in. Let's just make it easy. Let's say you're making $500,000 a year in gross revenue. Profit First says, I'm going to set aside 5, 10, 15, 20% of that gross number. So we're going to use 20%. That's the number I tend to tell people. 20% of 500,000 is $100,000. That is going to get put into a bank account, and I'm not going to touch it until my strategist tells me what to do with it. Okay. So one of the major benefits of modifying your cash flow in that direction, right, is one, you're a lot less tempted to overspend, right, during the year, during the week, during the day, because once that money is in another account, in a way, it's kind of out of sight, out of mind, which is where you want it, right? You do not want to be touching that thing. And of course, secondly, at the end of the year, if you've been putting in, your 20% all year long, when you come to your strategist and say, okay, great, I want to write off, I want to have this kind of plan and that kind of plan, you have the cash to actually be able to do an 831B program, or buy that car if we think the car is the right choice, or fund that defined benefit plan or the cash balance plan, whatever other strategies it is we want to do, pay the kids, whatever else.
So why 20%? I mean, what if my tax rate's higher or lower? Why? What's the magic 20% number?
Love it. So 20%, your tax rate, your actual tax bill, is charged based on the profit at the bottom, right? So if you bring in 500,000 and you actually have 300,000 of expenses, right, office supplies and staff and whatever it is, your net profit is 200,000. So yes, you might be taxed 30% or 40% or 50%, depending on your number, of that 200,000, but 30% of 200,000 is 60,000. Well, if you put away 20% of 500,000, you have 100,000, you only owe 60, which means you also have the money to pay all the tax.
Nice. So I've read about Profit First before, and then I assume there's also a profit account too, right?
Yes. Well, and so I guess I always call it a modified Profit First. So I do love the Profit First theory. However, I find that the original theory is very restrictive. And it's a little scary, especially for people that are just learning Profit First right off the bat. So if you've done it maybe a year and you're ready to set up the 5 or 6 different accounts, do it, right? The actual full theory of Profit First. But for a lot of clients, they've never heard of Profit First at all, ever. And when you tell somebody to put away 20% of their gross, the initial reaction is, I don't even take home that much. I don't even get paid that much, right? It's a big shock to the system. So what we generally do, we aim people for that 20%, but listen, first year, maybe you do 10, maybe you do 5, maybe, what can we do? But yeah, in theory, the full picture of Profit First, you have really 5 different types of accounts where you're putting little percentages in. So one is an owner's profit account, one is a tax account, one is an emergency account, right? Like an emergency fund. That one will stop, like you stop putting money in when you hit a certain dollar limit, right? One is typically an account for equipment, right? Especially if you're in an industry like a construction company where you're going to have some pretty significant heavy equipment costs. And the last one is the owner's fun account. Okay, so I always do my air quotes for fun because you want that new 85-inch TV in your office, right? It's still a business expense, but like, do you really need an 85-inch TV in the office? So that kind of thing.
My eyes aren't going so well, Shauna. I definitely need that 85-inch.
Get a note from your doctor. I'm in, Kirk. I'm in. Listen, in my opinion, one of the best things about having a business is that you get to live life the way you want to live it, right? Your business is your choice, and everything about your business is your choice. So working 18 hours a day when you first start your business is your choice, right? You could always go be a W-2 and work for somebody 8 to 5, So I really believe that if you can get in the habit of saving, I'm a big fan of out of sight, out of mind money. Right? So automatically right off the top, my deposit hits, I throw 20%. For me personally, I use this system. I actually set up my savings account at a completely different bank so that when I log in the morning, I only see my actual money I can use to spend on my business. My savings accounts, my 20% goes to a completely different bank. So I just don't even see it. So
I like that. That kind of gets into the envelope method a little bit. It's very similar. You just put it in envelopes and just put it away. And
yep.
Yeah.
I don't see it. It doesn't exist. I mean, the good bit about it, right, is that even if you don't do any strategy and you're still just having to pay tax at the end of the year, or whatever it is, if you put away 100,000, you have 60,000, you now have $40,000 for an amazing vacation, for an amazing putting into your kids' college, like whatever it is you want. That money is your money. So
40,000. That is an amazing vacation, Shauna.
It's an amazing vacation.
We do not spend that much.
I love it. Well, there's one trip that I'm super excited to take, but I think I'm going to need to make a little bit more. It's an around the world on a cruise for 8 months, and it's about $26,000 per person. And I'm like, So I'm working on putting that into my budget with my Profit First numbers here. So
yeah, I had a set of clients actually. That was their goal when they retired. It was $50,000 because 2 of them, and it was whatever 25 at the time, and yeah, that was their goal. $25,000 around the world cruise. Like, I cannot imagine living on a boat for 8 months with people that I don't know, maybe I don't like, but it's pretty cool. Like, I mean, just to be able to see the world. I mean, there's plenty of ways to do it.
At like 85 countries or something. I mean, like,
yeah, that's pretty cool.
And you don't have to unpack, which to me was the best thing of the whole thing. So
yeah, no, I went on a cruise once, the Baltic Sea, and we saw, I think, 7 or 8 countries, and it was really cool. Countries you never see. Like, I went to Russia, St. Petersburg, a bunch of countries, and like went to Tallinn. I don't know how you say it, but
beautiful
Tallinn,
in Estonia.
Yeah, never would have gone to that country, but the fact that we were there, we're like, hey, we go check this out. It was pretty cool. It was like the last medieval town in Europe.
Yep. Oh, that's so cool.
Very
so
cool.
But I think that's my favorite part about tax strategy, about Profit First, about all of these things. You work really hard to make money. Your money needs to work hard to give you what you want in life. Right. Because if it's not, what's the point?
Right. Exactly.
So
it's the point of money. Cool. So let's get into some other stuff, because I know we were talking before the show, and you had mentioned a point that I've seen this a lot too, but a lot of business owners COVID has, let's say, hauled out a lot of our economy, and a lot of the older generation retired early because they're like, I'm done, I'm not dealing with this BS. A lot of business owners are tapped out, accountants are tapped out, like a lot of people are just stretched thin. And so with a lot of business owners looking to sell, what are some things they should be thinking about as they go through this?
Absolutely. Well, and I think the first question always comes to, well, where are you in the sales process, right? So there's definitely a difference between you wake up one morning and you're like, that's it, I'm out. I'm done. I'm out. Okay. We can look at tax planning. We can look at entity sale, asset sale, these kinds of things. If you know that it's coming, if you have 5 years, perfect position. If you have 2 years, still pretty good, okay? Because there are things that you can do to increase the value of your business, like creating systems, creating recurring revenue, working yourself out of a job. For a lot of business owners, they are the key employee. And that's a big problem when you sell the business, because the key employee is no longer going to be there, right? You may be stuck working for the business for 2 or 3 years to train a new key employee, right? Which could be a problem. So depending on where you are in that phase, right? If you have 2 years, 3 years, however far forward is something to consider. But when you get to the point of the actual sale of the business itself, right? So you've negotiated the deal. You're going to sell your business for $3 million, right? There's easily 50 decisions that have to be made about how you're actually going to sell that business. One of the very first ones is that, are we doing an asset sale or an entity sale? Okay. So an entity sale means that you're selling the actual LLC, Inc., EIN with all the liabilities, with all the intangibles, you're selling the actual entity. An asset sale means it's not going with the EIN or the liabilities, it's purely just the assets. So the client list, the inventory, the equipment, whatever it is, okay? Now, the reason why this is such a big difference is because the IRS actually pits the buyer and the seller against each other in that sales process. And the IRS does it that way to make the actual sale as fair as humanly possible. Okay. Now, there's one other thing, and I'm going to mention it here. Won't go into a ton of detail, but there is something called the 338H10 election, which is kind of this weird middle ground. It helps both the buyer and the seller, but that's something if you're trying to get to a negotiation, because generally the seller wants an entity sale, the buyer wants an asset sale, an asset purchase. Okay, so the IRS has pitted them against each other. The 338H10 is kind of in between. It allows the best of both worlds, but there's a bunch of forms and the lawyers have to get involved and all those things. So I'm going to leave it out of today's conversation from that standpoint.
Okay, that's fair.
Okay. I'm going to mention it. If anybody has questions, reach out, because that could be 6 topics all on its own. Just that one election. Well, cool. So, I'm sorry. Go ahead.
No, go ahead.
I was just going to say, between the entity sale and the asset sale. So with an entity sale, the reason why the seller wants an entity sale is it effectively caps their entire sales price at being taxed at whatever the capital gains are for that business. So if you're for most people, when you're selling a business, it's going to be a higher dollar amount. It should cap your tax rate at 20% for the actual business sale. You might have some depreciation recapture, which would be at about 25%, but that's pretty rare. So generally 20% plus whatever your state tax rate is. With an asset sale, your tax rate can go as high as whatever the ordinary tax rates are. So they could go as high as 37% plus your state tax. So in some places, like California, for example, you could pay 63%, 6-3 on an asset sale. Okay. So that's the first consideration, right? And that's why the two parties are pitted against each other, because those are huge differences in tax rates. Now, once you've agreed, asset sale, entity sale, whatever you've negotiated with your CPA, running calculations on both sides with the attorneys and everybody being happy, the final question is, okay, great, Shauna, we're at this point. We now have a $3 million business sale. I'm going to pay a bunch of tax, whether it's 20% or 37%. Either way, I'm paying a bunch of tax. Okay. There are options to not pay tax. Okay. Now, many of these are deferral, right? So one of the very first ones that we see a lot of is something called an installment sale. And basically what that is okay, Kirk, you're selling your business and I'm going to be the buyer here today, and I'm buying your business. Instead of writing you a check for $3 million all at once, because that means when you have that money, you get hit with that tax bill, I'm going to pay you over time. So I'm going to pay you $10,000 a month for the next however many, 7 years or however long that's going to take. Okay. For you, that means that you're only paying your tax bill as you receive the money. So $10,000 a month times whatever the tax rate is, that's the bill. It's okay. It gives us some deferral, right? It does break it up, but Kirk, let me ask you a question. Do you really want $10,000 a month, or you want your $3 million?
I want my $3 million, Shauna. I want it now.
Right now, give me my $3 million. Absolutely. Because most business owners don't want to wait that long, right? They want their $3 million. They want to put it into retirement. They want to buy a yacht, buy an island, go on the cruise, right? A couple wants to go on the cruise, right? Got to have your money to be able to do that. So one of the next things to look at is something called a deferred sales trust. Some people call it a monetized installment sale. And what those types of programs do is they actually create an entity in between the buyer and the seller. So Kirk is going to sell. He's going to give his asset, his business, to this trust. And me, the seller, I'm going to pay the trust. So the trust is the one with the money. So Kirk himself as a person does not have the money. It's sitting inside the trust. And inside the trust, Kirk can use that money to invest in anything he wants to invest in. Now, if it's personal, if we buy that 85-inch TV and that the travel cruise for two, Kirk, right, that portion of the money is going to be taxable. But anything remaining inside the trust is not going to be taxable until you pull it out, which can skip 1 generation, skip 2 generations, 3, 4, 5. It can go on forever. So if you don't need the money to pay for something personally, a lot of people will use these monetized installment trusts, these deferred sales trusts, to be able to park the money and nobody pays tax until they pull it out. So pretty cool on that front.
That is pretty cool.
Sorry. He's like, I just want my $3 million. I want to do what I want with my $3 million.
Give me my money and no whammies.
Give me my money and no whammies. Right. Well, and so there are a couple other options. If you are interested in real estate, you can do what's called an opportunity zone investment. Okay. Now, good or bad, under the current law, the opportunity zone investments will be over in 2026. So that really is kind of deferring it for a couple of years. You might get a little bit of a portion of that, typically 10 to 15% that would not be taxable at all, which is kind of cool. But the money has to stay in real estate for 10 years to get that. So a lot of people like their flexibility. They like access to their cash because once it's in real estate, it's in real estate. Like you're kind of stuck. Not a lot you can do there. The only other type of option, big option for big dollars that I've seen is something called a 721. And this is really taking, not necessarily for business. This one really works if you're selling real estate, if you're selling something, so maybe the real estate within the business sale, if you own the building that your business is operating in, you can take the proceeds from the sale of the building. And if you like real estate as an investment class, right, as a part of your portfolio, instead of going back into another building like a 1031, you can 721 into a REIT, so real estate investment trust. And this would allow you to stay in real estate as a diversified part of your portfolio, but not pay any tax until the money comes out. So 10 years, 15 years, however long it is that you decide to keep it in the REIT.
Nice. Well, these are pretty cool things. I like it.
Lots of options. Always trying to, and I think that's the biggest part of somebody's specific plan is what you want versus what they want, what Bob wants are all completely different from each other. So it's really, when you talk about tax strategy, it's really important to know what is the person that you're talking to, what is their goal specifically, right? Because if you want to go on that cruise, well, Kirk, we know we're going to need at least 50 grand and we're going to pay tax on that 50 grand. So what other things, what other strategies can we implement to reduce that 50 grand to zero so you pay no tax at all?
So what do you find is some of the best, or what are some of the biggest challenges that business owners have when they're selling their business? You know, because I mean, it's kind of like retiring. You only do it once. And if you don't know what to do, you can screw it up. So what are some
100%.
things people should be thinking about?
100%. So one of the first ones, of course, make sure you have good counsel, right? So if your CPA is not used to buying and selling businesses a lot, work with a CPA, bring in a consultant that is, okay? Because if they mess up a form, if they don't add the right thing, if they don't do the right election, it can actually cost you quite significantly in taxes. So having the right team on board is super important. That also includes the pre-planning team, right? If you are the 5, 3, 2 years out in advance, starting to look at, as I said, there's about 50 things that you should be looking at to increase the value of your business, right? Why would you sell it for 1 if you think you can get it up to 1.5 or 2 before you're ready to sell? So those would be the biggest things from my perspective. And thirdly, let me phrase it this way. If you're selling to private equity, okay, or if you're selling to somebody who does this for a living, understand that they will know a lot more than you because they do it all day, every day, okay? I have seen multiple deals, like we'll come back to that 338H10 election, okay? I've seen multiple deals where the buyer tells the seller, oh yeah, this is great. It's not going to do you any harm. Okay, don't believe the buyer. Please don't believe the buyer, okay? You need your own advisors, your own set of advisors, and they should be separate, including the lawyer. So you should have your lawyer, they have their lawyer, because you want people that are fiduciary to you for your sale, for your interests. So,
yeah, I think that's great advice. Now, I know you have a book that's just come out. You want to tell us a little bit about the book before we kind of wrap it up here?
Oh, you are a sweetheart. Absolutely. Well, yeah. So the name of the book, it's on Amazon now, The 6% Life. So the title comes from the average for our clients is 6.92% in tax. So that's where the title is from. And the book itself goes over 7 different legal loopholes that any business owner can use to reduce their taxes. So especially since it is the beginning of the year and hopefully everybody listening to this podcast is all about tax strategy because I mean, really, who wants to hand over more money than they have to the government? Really the book goes into the aggression scale, the different strategies you can use. It also gives you pitfalls to watch out for and the actual steps. So step 1, step 2, step 3, like how do you do it? Okay, so if you're looking for a good read with some hot chocolate on a Sunday morning, I guess, I don't know, check it out, The 6% Life. I am very much an educator and I love helping people. It's always been my passion to bring the big boy strategies to the little guys. So that's what this book is attempting to do.
Awesome. Well, Shauna, I really appreciate you coming to the show and sharing your wisdom with us. Where can people find more about you?
I am super easy to find. Tax Goddess, and just look for the crazy redhead. You'll find me. I'm pretty easy to find. So taxgoddess.com. We're on TikTok and Twitter and Instagram and LinkedIn and all the things.
Nice. Awesome. Well, once again, Shauna, I really appreciate you coming to the show. We'll definitely have you back on in the future.
Thank you so much for having me, Kirk. Such a pleasure.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes. In the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right, well, that was a great interview with Shauna. And now we're into the panel portion of the show where we have our very own Barb Friedberg. Hey, Barb.
Hi, so happy to be here with you. Just you and I today.
Just the two of us. Just one of those special days. Recording this around the holidays, and people are off doing things that are probably more fun than what we're doing. So,
unless they're shopping.
Well, yeah, unless they're shopping or driving around or spending time with family or, pretty much this is the best thing. This is the best thing going on in the holidays, even though this is coming out in January.
Yeah, I think so.
This is good. This is good. All right. Well, let's dive right in. So, I know we talked a lot about advanced tax strategies. So, Barb, when we're thinking about tax strategies, whether it's for individuals or business owners, how should people be thinking about this?
I've talked to my accountant about this a lot because ever since the new tax law came into effect, those of us that used to itemize really have a hard time doing so. So, although tax rates are overall lower, those of us who could deduct our charities, and because of the new SALT tax, we really can't deduct that much and end up taking the general deduction. That leaves us with very little to do, except if you have a business and complete a Schedule C. And that just means you might be working at a job and you also have a side gig with some income. Because with a Schedule C, you can end up offsetting a lot of your income from that Schedule C by deducting related expenses. So the takeaway is you have to keep track of those deductible Schedule C expenses, whether they be supplies, whether they be taking a portion of your home as your office, if that is used exclusively for your business.
Yeah, I think it's really important that, this is one of those areas where, if you're not thinking about tax planning strategies, you're pretty much just lighting money on fire. And, we all work hard as business owners. For those of you who are business owners, we all work hard generating revenue as a way to, make more money, to pay employees for expenses and all that. We work hard on the income or the revenue generation side. But when it comes to the tax planning side, it's much easier to generate extra, I guess you call it profit. It's not really profit, but it's, extra money to use for other things just from making sure that your planning is correct. And I can't tell you how many business owners miss free money, just a pile of free money sitting in the corner of the room just waiting to be picked up. Like it happens all the time. I mean, I had a lot of conversations with Shauna over the years about this, and it's just scary how many business owners just leave stuff on the table. And this isn't even advanced stuff, right? This isn't even like, advanced stuff that nobody knows about, which I know she's really good at. I'm talking about basic blocking and tackling. And, and this also applies to individuals who just leave money on the table. And so, Barb, what are some things that individuals should be thinking about when they're, looking at their taxes as we head into tax season?
Well, you really want to look at all the credits that are available to you. There's educational credits, there are childcare credits, there are things that, there's earned income credits. So fortunately, if you have the internet, there are so many good resources like Tax Act or TurboTax, where they have a lot of really good articles that you can find out what type of tax credits you might be available to and take those. And then I ride Uber a lot when I'm on vacation, sometimes even in the city. We only have one car in our family. And I can't tell you how many Uber drivers I talk to, and they're doing this as a side gig. And my husband and I, for decades, have always had a side gig. That means regular job where we get a W-2 income, and then we have another biz on the side where we earn some money. And that's what I was talking about with the Schedule C. So read up even the IRS, although it's really boring, their irs.gov. It has a really good website. Take a look at the Schedule C and look at all of the potential deductions that you can use to offset that side gig money. And that will reduce your taxable income.
Yeah, I think it's a great point. And, employees are the worst off when it comes to tax planning. I get this question all the time from employees, like highly paid employees. Hey, what can I do to reduce my taxes? I'm like, start a business, buy real estate, do something. Like real estate has tax preferences, starting a business has tax preferences, being an employee does not. And there's really very little you can do as an employee, to save on taxes. I mean, there's obviously some things that people do, but the reason that wealthy people have a lot more complexity in their situation is well, probably in part because you can make good money doing some of these things, but also the tax advantages are enormous. I mean, buying real estate, huge tax advantages to owning real estate. Starting a business, huge potential tax advantages plus income benefits of starting a business. And the amount of things you can write off is substantial. And so, I've talked to some people in the past where they're employees and, if their company will consider it, it's like, hey, become a contractor for the company. Right now, obviously, you don't have the same status, so you're losing a little bit of security and stability, but some companies will pay you more. It's like if you're getting paid $100,000 as a W-2, they might pay you $130,000 as an independent contractor because they don't have to pay for benefits and all these other things that have to go along. And of course, it's easier to get rid of you as a contractor, which is a downside to it. I don't want to ignore that. But if you understand like the tax benefits of doing that, you can put away a lot more money. You can write off a lot more expenses, just all of it. Like if I'm driving to work, I can't write that off. If I'm a contractor, I'm driving to work, I can write that off, right? That's a client, right? It's not an employer, it's a client, and you can write off that. And I'm not giving tax advice. I want to be really clear because I'm not allowed to. But there's some things in there that are very clearly outlined by the IRS that you're allowed to do. And these aren't even questionable tactics, right? Like if you think about the spectrum of simple to complex, like there's some complex tactics people might say, you know what? I'm not sure I want to do that because it's a little bit in the gray. I don't want to play in the gray. This is like black and white, like very clearly black and white stuff. And I think, we talk a lot about tolerance for risk on the show. Like, what's your tolerance for risk? Like, are you very conservative, very aggressive? Tax has the same thing, right? Like, what's your tolerance for risk in tax? Are you afraid when you get a notice from the IRS and you just want to just give them all your money just to make them go away? Or are you like thumbing your nose at the IRS and come at me, bro? Like, show me what you got. And, anywhere in that spectrum, you have to have a comfort level because some of the tax planning strategies are on the IRS's dirty dozen list. It doesn't mean you can't do them. You can, but they're on the dirty dozen list because some of the ways that people do them are questionable, like conservation easements in the past. You can do them on your own property. There's nothing that says you can't. The idea of doing that is fine. What people were doing is they were buying into conservation easement like funds to get the credits, and it's like, well, this is clearly only purpose of this is to get the tax credit, not to do the other things that it's intended for. So, I think every once in a while you get some stuff that's on the fringes, but in general, there's a lot of opportunity out there that people aren't even looking into. Like R&D tax credits are a wonderful way to get tax credits, but very few people know about them. So,
oh, sorry.
Go ahead, Barb.
I remember years ago, I used to subscribe to Money Magazine, and they did an experiment where they'd give the exact same data to 7 different CPAs, and they would all complete a tax return. And what do you think? Did they all come out with the same amount of tax due, the same exact tax return, Kirk?
Nope.
Exactly. Which is to your point that you can be compliant with the law and come out with a different tax return. And like you said about being scared of the notices, I don't know about you, Kirk, but I regularly get notices from the IRS for this or for that or for the other. And, you just deal with it on a point by point basis. And you may get that even if you don't take a risk. So it's actually when I, many years ago, every year I used to read through the tax code to see if there were changes, to see what I could take. The tax code has changed so much that it's much simpler now, although it may not seem so, but there are fewer deductions that you can take as an individual. So, but on that note, you might want to just pick up one of those tax guides that come out every year and skim through it. They're not that expensive, and see if there's deductions that you are missing.
Yeah, no, I think it's really important. If you mentioned that different people have paid different taxes with a similar situation. Um, I see this all the time, right? And I think you also mentioned that getting tax notices. I mean, look, the IRS has been broken for a number of years. There's a lot of things that are messed up there. One of which since COVID. I mean, I got a notice that should have come out 2 years ago. I got it like last week. Should have come out 2 years ago. Like, when are they going to send this to me? And finally they did, right? It's like, oh, we owe you money or you owe us money. It's like, some small thing. But, for a long period of time, things were broken. I work with a lot of accountants, and many of them are telling me that they're just getting bombarded with tax notices on clients that don't deserve to get one, right? They're just like, oh yeah, we need this thing, and it's like, well, your systems are broken. Like, yeah, we know they're broken, but we don't have manpower or funding to fix it. So tons of people get these notices and they don't even deserve it. I can't tell you how many notices I've gotten over the years that are undeserved, and some of them scare the crap out of me. Like one of them, one of them was great. It was like, yeah, we owe you $30,000. And I'm like, great, I can't wait for the check. And of course it never appeared. Then a week later, it's like, you owe us 30,000. I'm like, wait a minute, what's going on here? I don't owe you 30,000 either. And it was this back and forth of there's some screw up on their side. And we finally realized what happened, and they, whatever it was, they were missing some form and it didn't process. And they're like, oh, sorry, no issue. You're all set. But the reality is that happens, right? It's an imperfect system with imperfect people. And so you should always, I mean, if you use an accountant, you should always talk to your accountant if you get a tax notice. Most times it's garbage, and sometimes it's valid, but you're probably going to know if it's valid, right? Like, if you owe the IRS money, you probably know you owe them money. I mean, sometimes it can be a mistake and you're like, oh, I didn't account for this, or, sometimes that happens. But generally speaking, you're not going to get too surprised. So you should be aware of it. But, it doesn't mean that you can't plan around it, right? Like, oh, I know I'm going to have a big tax bill this year. What can I do about that? Well, let's try doing the planning in December or November instead of in January or February, right? Which is when most people do it. Like, oh, can you save me some money from last year? No, it's too late. You missed it. Maybe you can contribute more to a retirement plan, but that's about it. Like, you're done. So, tax planning is really important. And if you work with an accountant, and they're not, so I just want to leave this out here. So it's really, accountants, they're overworked, they're underpaid, they're underappreciated. I'm just saying this to start the conversation because I think it's really important. If you're working with an accountant, most accountants don't have the time to do tax planning for you unless you ask. If you ask, they'll do it, but they're not proactively going to say, "Hey, can you do you want some advanced tax planning?" They just generally don't because they don't have the time. But if you ask, they'll do it. So you need to be proactive and ask. It's not because they don't care. They do. It's just because they're overworked, and they don't have enough time. So one thing to think about is talk to your accountant and say, hey, I need some tax planning for this year. Can we set aside some time in November, December to do that? Secondly, if your accountant doesn't do that or isn't equipped to do that, just message us in the show. I know a ton of accountants that do that, and they're really good because I've had to find them because, generally they're not a lot, but they're proactive. So let me know if you need somebody. I do have a number of people who are pretty good. But just make sure you have somebody who's proactive because none of us sit around and read the tax code. Sounds like Barb does. Barb might be different, but none of the rest of us read the tax code unless we're trying to put ourselves to sleep. So you're probably not going to find the good stuff. You need to find somebody like Shauna or a handful of other people that are really good at finding the threading the needle, if you will, and finding these really cool tax strategies. There's tons of them out there. You just really have to find somebody who understands, how to locate them, and especially if you have a high income, you need to be able to save money. So it's really important to know how to do that well in advance of the end of the year, so you can start, reducing your income before it's too late. So I do want to get into a little bit about bonds because we talked about this before the show, but bonds are in this weird area where they've been, good old boring bonds, and now they're getting interesting. So Barb, what are your thoughts about bonds and kind of where things are going with interest rates?
Finally, my topic. I haven't been investing in bonds since I started investing in my 20s. My dad loved bonds. He loved the high yield bonds. And back in the day, we could get 10, 12% return on a bond, which is unheard of today. People are going 5%. That's great. Let's dive in. And actually 5% is the long-term return on bonds over historical time periods, decades. So first of all, let me describe what a bond is in case you just don't know. It's a loan to the government. Then not the government. It could be to the government. It could be to a corporation. It could be to a city entity, whomever. You loan money to an entity, they give you interest, and that's called your coupon payment. Right now, after the Fed has raised interest rates up to the highest levels in roughly 22 years, bonds look interesting, particularly government bonds, because you can get a 5% return on a 13-week, 26-week, shorter term T-bill, and it's secured by the U.S. government, which theoretically is supposed to be pretty safe.
Theoretically.
So I would encourage people who have shied away from bonds in the past to give them a look. You can get them through diversified funds, ETFs, mutual funds, individual bonds, and even younger, more conservative investors will benefit from some regular cash flow and finally, and a little less volatility than you get from your stock portfolio.
Yeah, no, I mean, bonds have been interesting for a while. We've been talking about it on the show, and I think it's always a good idea to push your comfort zone because most people aren't familiar with bonds. They don't know how they work. They're just boring. Everyone wants the juice of the stock market, but if you can make 5.5% virtually risk-free versus taking risk in the stock market, maybe it's up 20, maybe it's down 20%. If you look in the early 2000s, 2000 to 2013, you would have got close to 0% return until July of 2013 in your stock portfolio. Like you would have made no money. In Japan, it was like 33 years, I think, 33, 34 years in Japan before it started to make money again in the stock market. How would you like to sit on your money for 34 years before it starts compounding? You'd be better off sticking your money in the mattress. But I think what a lot of people don't think about is the fact that, just because something has happened doesn't mean it's always going to happen. And I think this is one thing I want to talk to you about, Barb, is expectations, right? So people right now, individual investor expectations are, hey, they're just going to drop rates in another 3 to 6 months. Are they? Because Powell's not saying that. Powell's saying the end of next year is the glide path, and the market's talking about 3 to 6 months. Is that true? I don't know. We'll see. I think if we go into a massive recession, sell-off market crash, they might lower rates. But besides that, why should they lower rates? There's no reason to. The markets are close to all-time highs as of this recording, this is mid-December. Markets are close to all-time highs, and inflation's dropping. So why would you lower rates? Everything seems to be fine, right? There's nothing to see here. So it's just a question, right? We get conditioned over and over again that yeah, they're going to drop rates because of this. Like, why should they? There's no reason to drop rates at the moment, right? Things change, but at the moment, there's no reason to drop rates. So why would they expect that? And I think in large part it's because people are expecting a recession around the corner in early next year, and that's probably why they think it's going to happen. But people have been expecting a recession for the last 2 years. Have we seen one? I don't know. It just depends on your definition of recession. This gets into the Democrat tilt of Bill Clinton. What's your definition of is? This what's the definition of recession? People thought we had a recession last year, but apparently we didn't. So I don't know. It's an open question. I think the real question is should you invest in bonds or not? So I don't know. What are your thoughts, Barb? Like at the moment?
I think you should have a diversified asset allocation in your portfolio. And unless you have a steel stomach and can handle a potential 30 or 40% drop in your equity portfolio. And I actually have a friend who's a financial planner who is pretty much 100% in stocks. And he's like, I can take it. I've been through it before. It's fine. I can't. I believe most people cannot handle a 30 to 40% drop in their portfolios. Therefore, you should have some bond exposure. Because contrary to 2022, when the stock market went to crap, bonds went to crap, that was a very, very rare situation. That has not happened in decades and decades. So bonds in your portfolio will do two things for you. They will give you some cash flow. And when interest rates do fall, you will get some capital appreciation. And it's kind of like a ballast. We always talk about asset allocation because we don't know. The future is uncertain. We don't know what's going to happen, as Kirk was alluding to. We don't know. And so your diversification provides what little guard we can have that we can control that will keep our portfolio from getting way, way, way too diversified. Because the worst thing that can happen is there can be a stock market decline. You panic, you get freaked out, you sell your stocks at the bottom, then you don't know when to get back in. So you miss the run up and you're much worse off. Whereas if you have a balanced stock and bond portfolio, when the stock market crashes or when the bond market crashes, there's going to be other assets to prop up your portfolio. You're going to minimize your losses. And overall, you're going to have a more stable ride in your investments. And both stocks and bonds over the long term have delivered very good returns. Stocks have averaged 9 to 10%. Bonds have averaged around 5%. So having some of both in your portfolio is a smart path, even if you are a younger person.
Yeah. So, I think it's hard because we've been conditioned with this idea that bonds are for old people, for retirees. And it's only because people focus on the income and they say, oh, it's a conservative investment. Well, I guess tell that to the people on 30-year treasuries that are down 54% this year, how conservative they are. But, I think people need to change that stigma because, bonds produce income, which is great. But, if you look at the 70s and early 80s, hell, if you can get a 15% return, that's better than equities. Why would you even invest in equities if you're getting a 30-year virtually guaranteed yield from the U.S. Treasury, right? Why invest in equities at all? I'm not saying you shouldn't, but that's a really good return for 30 years. 30 years from now, I don't know where rates are going to be, but I'm sure they're going to be lower than 15%. So, I think people just need to reconfigure like what their vision of bonds are. Because I think virtually everybody I talk to, they're like, why am I not in the stock market? Like, I don't know. Why do you have to be in the stock market? And there's not really another answer beyond that. It's just, well, because we've always been in the stock market, or because everyone else is in the stock market, or that's what's on TV, or some other reasons. It has nothing to do with like a real reason. It's just more like, well, this is what I know, right? Which isn't wrong, but I think what you should recognize, if your answer is similar to what I just said, then you need to relook at what your reasoning is, because your reasoning isn't because it's the best thing, and actually with some data as to why it's the best thing. Then you need to actually take a step back and look at why or why not you should have certain asset classes. Because if you're in real estate because everyone else does, or because it's going up, that's not a reason, right? Tax advantages, okay, that's a reason, right? Because it produces income, okay, that's a reason, right? Or the income that I need, okay, that's a reason. But because everyone else is doing it or it's going up are not reasons, right? That's speculation. That's not investing. And if you want to speculate, go to the dog track, go to the horse track, go to the casino, right? You can do that on Wall Street, but I wouldn't advise it. People listen to the show. I know there's some professionals listen to the show, but in general, like, that's not for most people. So I think you just need to take a step back and look at, and I also want to talk about this, you Barb, too, is the relative degree of expensiveness of markets, right? Of stock markets and other assets. Like, what are your thoughts on that? What should people be doing considering things are so expensive?
When we say the stock market is expensive, typically what we're saying is the price you pay for $1 of earnings for a company or a fund is pretty high right now. And that's typically measured by the PE ratio. Now, some people don't care about that, and they just say, I'm going to go for growth and I don't care what the cost is. But historically, when stocks and stock markets get too overvalued, they tend to go back to a more reasonable valuation, which means their prices will fall unless earnings just go through the roof, which typically is not what happens. Now, the problem with this theory is, yeah, that's what happens, but we never know when. But right now, you can look at the PE ratio, the Shiller PE. You can find this all on the Shiller website. It's multiple.com. And you'll compare the price of the stock market with the mean, the average. And we're seeing the S&P 500 around a PE of around 25 or so, and the mean is 15. Now, the trick is the markets can stay overvalued for a long, long, long time, like decades. So we're not telling you to make a decision based on this, but just to be aware that you might want to have some money left on the sidelines, because when the market does take a dip or revert back to more normal averages, you might want to have some money to invest in the stock market when the prices get a little cheaper. So this gets down to a lot, Kirk. The topics we're talking about really are a lot of educational topics. And obviously, we're not giving a full course on the bond market, on the stock market, on valuations. But if you want to invest, it's really a good idea to get some basic education, understand the stocks, understand bonds, what they are, how they perform, and places you can get that education. Investopedia has wonderful articles. Your brokerage firm, Schwab, Fidelity, and not TD Ameritrade, but other brokerage firms have really good articles as well to boost up your knowledge of basic investing concepts, as well as a lot of really good basic investment books.
Yeah, well, on that note, we're gonna wrap it up here because I think, as we're getting close to the end of the year, and of course this comes out in mid-January, and people are starting to look at their taxes. But I would highly recommend everybody to obviously continue to listen to the show, because why wouldn't you? but outside of that, I think one of the things we want to do in 2024 is have a lot more shorter, punchy videos that we'll put up on YouTube, which are really designed to discuss certain topics we do this on the show on our Friday episodes where we kind of talk about certain concepts like mental models. But I think, some of the things like bonds, like inverted yield curve, what does that mean? Like just talking around certain issues that come up a lot. I can tell you, I almost have conversations weekly with clients about bonds because people haven't owned them in so long. And so they just don't understand bonds. And I get it because when I started, I hadn't owned them in so long, I had to look them up. I'm like, all right, I got to make sure I understand all the nuances before I start investing them in again because, I was rusty, right? When interest rates were zero for like 10 years, there's no reason to own bonds. So if you're owning bonds, like it had to be a really special situation. But anything you don't do for a while, you get rusty, right? Like I know some people buy convertibles or doing, weird stuff they invest in. Like I know some people that are really good in like the 90s, and I forget what it was they were investing in, but there was some weird fixed income hybrid equity structure, and they were really good at it. And then they didn't do it for years. And I was talking to the guy, is like, man, I used to be really good at this. I don't remember half the stuff I knew, but so just my point is even experts that do this all the time, if you're not doing it all the time, you get a little rusty. And so don't feel bad if you haven't owned bonds in a while or if ever. Don't be afraid to look into them, right? Like bonds are an asset class too. And I'm not saying they're extremely cheap right now. I think, if you're looking in early December, probably November, I think it was when the 10-year and the 30-year treasuries peaked out at a yield and it started to come down. But just keep in mind that they are an asset class, and if you invest properly, you can actually lock in a good rate. I mean, 5% for 10 years is probably a good rate. I don't know where things are going to go in 5 or 10 years, but I mean that's a pretty decent rate, 5%, right? And I was talking to a guy yesterday, and he was laughing. He's like, imagine if we had a positive real rate of return on fixed income. Imagine what that looks like. We haven't had that in like 20 years. And like, imagine you can get 5% and inflation's at 2%. Like, wow, what a novel concept. Yet that's the way it's been forever, but except for the last 15 years, it hasn't. And people just forget what that's like. You can actually make money over an inflation on bonds, which right now you can. But not saying that'll always be the case, but for the moment you can. Anyway, Barb, final thoughts from you, and where can people find more about you?
Remember to take a look at your asset allocation. That means the relationship of stocks to bonds to other types of assets. Keep it in line with your risk tolerance. Don't forget to learn. Doesn't have to be boring. You don't have to spend hours, just a couple of minutes brushing up on concepts. I'm Barbara Friedberg, and you can find me online. Look me up. You can email me at my website, Barbara Friedberg Personal Finance. See you next time. Bye.
Great. Thanks for coming on, Barb. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.